Hello everyone, welcome to Betty our Academy. Our job is to make school easier. Kindly subscribe, watch, like our videos, share, comment down below, and don't forget to hit the notification bell. So in this lesson, we are going to learn about the capital structure and its theories. So these are the points that I'll be expounding on. So we start with the capital structure. It means a combination of all long-term sources of finance. It includes, these are the sources of finance: equity share capital, reserves and surplus, preference share capital, loan, debentures, and other such long-term sources of finance. A company has to decide the proportion in which it should have its own finance and outsiders' finance, particularly debt finance. Based on the proportion of finance, WACC, otherwise referred to as weighted average cost of capital, and value of a firm are affected. There are four capital structure theories for these. So these are the capital structure theories here. We have the net income. The net income. We have the traditional approach. We have the M&M approach. And here the fourth one is, we have the fourth one here, which is the net operating income. That is the fourth one. The fourth one is the net operating income. So those are the four capital structure theories. So capital structure is the proportion of all types of capital. We have equity, debt, preference, etc. It is synonymously used as financial leverage or financing mix. All those ones, they refer to the same thing, which is capital structure. So capital structure is also referred to as the degree of debts in the financing or capital of a business firm. So the degree also refers to that. So financial leverage is the extent to which a business firm employs borrowed money or debts. So in financial management, it is a significant term and it is very important. It is a very important decision in business. In the capital structure of a company, broadly, there are mainly two types of capital. We have equity and debt capital. So if you are looking at the sources of finance, you have the equity and we have the debt. Out of the two sources of finance, because the rate of interest will be less than the cost of equity. And the interest payments, they are tax deductible expense. Interest payments are not taxable. So it means that it is cheaper source of finance than equity, because from equity, if we have the issue, if shares have been issued, it means those shareholders, they are entitled for dividends. So and interest payments are tax deductible expense. So capital structure or financial leverage deals with a very important financial management question. The question is, what should be the ratio of debt and equity? What should be the ratio? So we should know the objective of doing all these in the financial management context. The objective of any financial decision is to maximize the shareholders' wealth or increase the value of the firm. So you ask yourself, why start a business in the first place? So the shareholders, they need to maximize on their shareholders' wealth or increase the value of the firm. The other question which hits the mind in the first place is whether a change in the financing mix will have any impact on the value of the firm or not, because at all times the shareholders, they need to increase the value of the firm. The question is a valid question, as there are some theories that believe that financial mix has an impact on the value and others believe it has no connection. So in regards to that, that's why we have those four. These are the four theories. So then there's this particular question that we are seeking to answer, right? Does financial leverage affect the value? The value of the firm, does it? So one thing is sure, that wherever and whatever way one sources the finance from, it cannot change the operating income level. So regardless of where you're sourcing your finance from, it cannot change the operating income levels. So financial leverage can at the maximum have an impact on the net income or the earning per share. The reason we are discussing later is that we have changing the financing mix means changing the levels of debts. This change in levels of debt can impact the interest payable by that firm. The decrease in interest would increase the net income and whereby the earning per share, and it is a general belief that the increase in earning per share leads to an increase in the value of the firm. Apparently, under this view, financial leverage is a useful tool to increase the value, but at the same time, nothing comes without a cost. Financial leverage increases the risk of bankruptcy. It is because the higher the level of debt, the higher will be the fixed obligation to honor the interest payments to the debt providers. So, when you look at the discussion of financial leverage, it has an obvious objective of finding an optimum capital structure leading to maximization of the value of the firm. If the cost of capital is high, right? So we have those theories or approaches to financial leverage or capital structure or financing mix. Yeah, and these are the theories. We have the net income approach. This one is the first one. This approach was suggested by Durand, and he was in favor of the financial leverage decision. According to him, a change in financial leverage would lead to a change in the cost of capital. In short, if the ratio of debt in the capital structure increases, the weighted average cost of capital decreases, and hence the value of the firm increases, right? Then we have the net operating income. This approach is also provided by Durand. It is the opposite of the net income approach if there are no taxes. This approach says that the weighted average cost of capital, the weighted average cost of capital remains constant. It believes in the fact that the market analyzes a firm as a whole and discounts at a particular rate that has no relation to debt-equity ratio. If tax information is given, it recommends that with an increase in debt financing, WACC reduces because of the tax shield on the tax payment, on the interest payments. There's that tax shield, and the value of the firm will start increasing. Yeah, so that is under net operating income. And the traditional approach, this particular theory, this approach does not define hard and fast facts. It says that the cost of capital is a function of the capital structure. The special thing about this approach is that it believes in an optimum capital structure. Optimal capital structure implies that at a particular ratio of debt and equity, the cost of capital is minimum. Yeah, and the value of the firm is maximum. Yeah, so that's what it believes. And we have the last one, which is Modigliani and Mila approach, otherwise referred to as approach. It is a capital structure theory named after Franco Modigliani and Martin Mila. Theory, it proposed two propositions, which is proposition 1 and proposition 2. Proposition 1, it says that the capital structure is is irrelevant to the value of a firm. The value of two identical firms will remain the same, and value will not affect by the choice of finance adopted to finance the assets. The value of a firm is dependent on the expected structure, expected future earnings. It is when there are no taxes. Then proposition 2, it says that the financial leverage boosts the value of a firm and reduces WACC. It is when tax information is available. So to summarize, it is essential for finance professionals to know about the capital structure. So accurate analysis of capital structure can help a company by optimizing the cost of capital and hence improving profitability. So that's the end of our lesson. Kindly watch out for our next video. Don't forget to subscribe and hit on the notification bell. Until next time, goodbye.